Dang, the CPI inflation figures, whether they're a lie or not, they came in hot today, and they certainly feel like they're put together by a patchwork that is more messy than Kate Middleton's photo. Yeah, that's a problem. And so what we got is reads that were all hot by 0.1%, with the exception of a match on the month-over-month read. So everything came in slightly hot, but what was mostly concerning is that the trend of services inflation is moving sideways. If anything, it might actually be starting to move up. Many of you know that I'm a big fan of looking at technical analysis, and I haven't done this before, but I think you can agree with me in saying that the trend of where super core inflation is going is not good. And so even if you're not super into technical analysis in stocks, just take a look at this with me and tell me what you think. So we're going to take this little red bar right here, and all we're going to do is try to draw a trend from the beginning of 2022, right about here, when the Federal Reserve started raising rates. Can you believe it's been 2 years? Look at that. If I go from the beginning of 2022, I actually have to slightly tilt the trend up just to get to that black line core, or super core. This is called services minus housing is the super core figure here. And you get an uptrend despite 2 years of interest rate increases. Now, if you looked from January of 2022 to the summer of 2023, you'd be saying, hey, we're Gucci. Look at that beautiful downtrend. But again, if you average past, we're at a slight uptrend. And worse, if you look since the summer of 2023, look at this, folks. That is not good. That is not a good trend. And unfortunately, that trend line right there is going to lead the Federal Reserve, in my opinion, to go for the summary of economic projections. What month are we in? March 20th, we're going to get the Fed's summary of economic projections. It's also baby summary surgery day, so knock on wood, pray for summer, but also pray that we don't get reamed by the Federal Reserve. But then again, they're kind of giving us the blueprint saying you're going to get reamed. Remember what Jerome Powell warned us. He made this extremely, extremely clear. In December, he said the 3 and 6 month charts are looking great. We're at 2%, whatever, right? What did he not tell us in January that pissed everyone off? He refused to talk about the 3 and the 6 month charts. Instead, all he kept telling you was to mark your calendar for June 21st to 23rd and go to the Millionaire Symposium to learn everything I know about real estate and finance, innovation, and our guest speakers by going to meetkevin.com and buying yourself a ticket to Vegas. But no, look at this. So we actually jump. Let's go push the right button here. Go right here. What do we have? This is the 3-month annualized trend, this light blue figure right here, which in December, this looked really good because in December, you really only had a chart that looked like that. That was about December. See how it's basically all plummeting over there on the right? That looked fantastic. But then what happened? We got our first little uptick. Oh no. And then we got more of an uptick. And then we got more of an uptick. And see, look at the 3-month and the 6-month now. They're both up. They're both higher than the 12-month. And so when the 3 and the 6-month are higher than the 12, it's only a matter of time for the 12 to start U-shaping up again. Why is that a problem? Because that's a 4% handle right there. Everything's converging on 4% for core consumer prices. Fed is not okay with that. And you have to now combine that. What did the Federal Reserve do to us about a week ago in Congress? They told us that everything was a lie to begin with. They told us that flexible average inflation targeting, which we have been holding on to for 2 freaking years. 2 years. For 2 years, we've been, look, if we just get close to 2%, the Fed's going to go, flexible average inflation targeting. We're good. We could go back to 0% rates and have a party. Okay, we didn't really expect them to go back to 0, but we were expecting them to pull out fate, be like, hey, we didn't mention we had this policy framework we decided on in 2019, conveniently before the pandemic. I'm not even going to get into the whole conspiracies of it, called flexible average inflation targeting. And as long as inflation averages 2% over the long run, we're good. And what did Jerome Powell tell us last week? Yeah, that was a lie. That's what he told us. Okay, that's not the word he used. What he actually said was, yeah, well, when inflation was trending below, we wanted people to anchor their inflation expectations higher, so we came up with a policy framework of flexible average inflation targeting. And that policy, now that inflation is higher, would be less applicable today. And we're going to review the framework at the end of this year, and it'll take about a year to go through it. So in other words, they're basically going to throw it in the trash, is what it sounds like. You certainly can't rely on fate like we used to, which maybe that was fate all along, because after all, like Elon says, fate loves irony. But we got some other issues here, okay? We got other issues. It's not just the charts that you just saw, but I want you to see the broadening. Now, this is pretty rudimentary, what I'm about to show you. It's probably funky to some regards, but I like it. So last month in January, we covered what I called well, I didn't call it this then, but we're calling it today the KC CPI, the Kevin Core CPI. And I know we're not adjusting for seasonal factors and we're not going super hard here, but what we did last month is we decided to take the core CPI read of 0.39%. And what we did is we subtracted housing, vet services, vehicle insurances, and medical services. The reason we did that is because we thought those were lagging items. And when we took those things out, we're not saying they're not important, we're just saying when we took those out, we were only left with 0.1% on super core, which was pretty nominal. That's pretty low. Okay, cool. So what happened when we did that this month? When we did that this month, we ended up with a figure that was much higher. We ended up with a figure that was about 0.17. And the last month was 0.1. Why is that a problem? Well, it's because we're starting to see a broadening, which is worse. That number being higher, just removing 4, means the core inflation figure is pushing up because of a lot of other factors. And so then we just did sort of a rudimentary scroll through to try to mentally fact check, okay, is that really what's happening? Okay, well, let's look at services. So rent of shelter moved down to 0.4 from 0.6, but we've been at 0.4 forever. Okay, big deal. So January was a little warmer because they gave more weight to single families. Fine. But look at this. Moving, storage, and freight up 2%. It was down the prior 2 months. Now it's up 2%. What do we have? Eyeglasses and eye care up 0.7%. Dental care services up 0.4%. You've got care of invalids up 2.6%. The ones with the stars on the right and the ones I'm reading off right now, these are higher than they previously have been. So eyeglass higher than previously has been. Health insurance came down, but transportation services went up. So it's like you win one, but you lose another. Are we ever actually making real progress on this? This sucks. It was supposed to be transitory. It's not. Car and truck rental. Like, okay, cool. Health insurance goes down, but car and truck rentals explode. We were at 1.3 to the negative and 0.7 to the negative. Now we're at 3.8. It's a disaster. You go down a little further. What do you get looking for those little X's? Pet services, up again. Pet frickin' services, up 0.9, 0.9, 1.0. That's not sustainable. Those are 10% annualized price increases or more. It's insane, 10 to 12%. You go over here, what do you got? Admissions to sort of events, up 1%. It's probably T-Swizzle's fault. Education and communication services, 0.5. That was higher than previously. Postage services. Postage. Who still mails stuff? 2.2%. And those were just those that were higher than the last ones. But that doesn't mean that the last ones were low by any means. Some of the last ones were still high. Just because a number is lower this time doesn't mean that it's low enough. Let's look at one. Let's go find, here, recreation services. Oh, that one's actually higher this month as well. I just didn't start. But, even 0.4% for recreation services from last month is too hot. So this is a problem. So what's the bottom line for what this means for the Fed? Well, I think this kills May. This report kills May, in my opinion. We talked about March getting killed. There was some thought that, oh, maybe the banking crisis might end up pushing the Fed to cut. This kills May. This killed March. Well, March has been killed for a while. Now this kills May. Not only does this kill May, but the market agrees with me. The market just adjusted to a 90% chance of no rate cut in May. And honestly, it's probably going to be 100% no rate cut in May. Now, we do have a 70% chance of a rate cut in June. I think the Fed's going to screw that. I think the Fed's going to wait until the second half. Why do I think the Federal Reserve, I'm calling it here, I'm not sure, but I'm just going to say it as if I believe it, because I do believe it. I don't think the Fed's going to cut until July. I'll tell you exactly why. So, what did I tell you that the Fed is looking for when we looked at ehack.com? Remember, on ehack.com, I post all my sort of research and commentary. This is actually a great tool for me. It's a tool that I've always wanted. Some one giant frickin' scroll list of all my opinions and ideas, at least the ones I write on here. What did I tell you right here? We need the 12-month figure to prove it's not going up, right? Well, it's not going up yet. We've only had about 6 months of data. So you really need at least another 4 months. Well, that puts you to July. So look over here. We can actually get the bottom. Where's the bottom? Right here. See the bottom where you lap the year over years? This is going to be June and July. June, July, right here. June, July. So when are you going to lap those figures to see if your year over year is a lot higher, which right now it's trending higher? By July. So June, July-ish. I personally think we're probably stuck waiting until July. Now, one of the things you could do as well is you could look at when the Federal Reserve's signaling meetings are. So we go to the FOMC meeting schedule and watch this, okay? This is another reason I think it's July. We're going to get the March 20th meeting, summary surgery day. March 20th meeting is a summary of economic projections day. That is a market signaling day. They're going to signal to the markets what they're going to do, and they're going to see what the market's reaction is. Then in May, they probably do nothing. Guess what June is again? June is another summary of economic projections month. Why would you do a rate cut on a SEP month? You probably wouldn't, because you can have enough power to move markets with a summary of economic projections rather than rate cuts. So you buy yourself to July when you don't have a SEP meeting. There is no summary of economic projections in May, but we're not getting a cut in May with this report. And there's no summary of economic projections in July. So I am hereby declaring, for what it's worth, we're not going to see rate cuts until July at the earliest. Now, why is that problematic? Well, because that means there are only 4 meetings left. So unless you got a larger than 25 basis point cut, you're going to be stuck with 25, 25, 25, 25. At most, you're at 4 cuts. At most. And we've already had the Fed say they might cut and then wait. Cut and then wait. Which is basically the equivalent of not doing a 25 basis point cut, but it's actually a 12.5 basis point cut. It's like instead of the Bitcoin halvening, it's the rate cut halvening. Oh, you thought you were going to get 50 basis point cuts? Now you think you're going to get 25? How about 12.5 basis points? Like, I laugh because it's painful. Now, what is it painful for? It ain't painful for the bond market. Well, I mean, it is because bonds sell off, but yields, like if you're going to buy, yields are up. Yields are up 3.1 basis points at the time of this recording. Who's it not painful for? AI doesn't give a hoot. Oracle earnings were great. AI doesn't give a flying F. Why? Because the rich, cash-rich companies are just going to keep printing money with their good old money markets. Great. Who else is, AI doesn't care. Cash-rich companies don't care. Who cares? Well, sellers of real estate. That's going to give us more opportunities for househack. Learn about investing in househack at househack.com/2024. Link down below. Read the prospectus. We do have an offering. So if you want to invest in househack, there's an opportunity to do that. And we're setting up how to 1031 exchange your real estate into our real estate. So if you want to learn about that, email us at ir@househack.com. We've got a cool announcement coming up within the next few days about that, so we're really excited about that. But who else is it bad for? Well, obviously, the interest rate sensitive sector. puts more weight for longer on solar, manufacturing, cars, whatever, anything that's interest rate sensitive. So it sucks. But anyway, this is exhausting. It's not the CPI report we wanted, but it's the CPI report we got.